Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Sundaram Clayton, an interesting auto ancillary company. So let's understand about its business and let's understand whether you should invest or not. So let's get started. First of all, a disclaimer that this is not a stock recommendation and people taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about Sundaram Clayton, here's a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel, help you also ask me questions in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and a number of podcasts that I put up for short-term calls on stocks and long-term calls on stocks as well. For detailed market or company talk or a number of stocks you are holding, you can directly email me and we can work things out. Now about the company. Established in 1982, Sundaram Clayton is a TVS group company and they provide aluminium and magnesium castings for the automotive industry. It boasts of marquee clients. SCL or Sundaram Clayton was the flagship company of the TVS group, and then TVS Motors went into it with their scooty brand and etc. Mostly based in India. First unit abroad was established in 2019, so they are trying to you can say export abroad or establish themselves abroad as well. Their clients include Cummins, Volvo, Daimler Trucks, Packard, and Webco, etc. So that's Webco, not WPCO, but Webco. If you look at the numbers, and these are Q2 numbers, so Q2 FY21 versus Q2 numbers of last year. So the market cap of the company is around 5,000 crores. Sales is around 292 crores that has come out from 343 crores. So that's a dip of around 15%. Profit surged from 1.4 crores to around 8.7 crores, and that was pretty good. But you need to understand that being a low debt company, profits low in FY20 on back of higher other income loss and higher interest cost. So there was an you can say an extraordinary other income loss in FY20, and that's why FY21 profits look better. And there is higher interest cost last year, and interest cost has reduced and the debt has become extremely low. It trades around 39-40 times current earnings, which looks extremely expensive, and the stock has run up. So I'll discuss about the technicals later. High combined promoter and institutional holding with around 9.5-10% free float. So that's a very big positive for this small cap company. If you look at the performance of the company, so profits were doing well till 2018, but then you may understand that the automobile industry went through a very difficult phase for the last 3 years. So had a sharp drop in FY19, and we saw that, but numbers are back on track. So the numbers were not that great for around 2-3 years, but they are coming back on track, and stock fell 50% in the Feb March fall of 2020, and it has doubled since then. So from those levels of 1300 odd levels, it is now at 2600, but the stock is still down 60% from the highs of 2017. So you can understand that what sort of you can say potential the stock has once the auto industry comes back into focus and really these stocks surge. And that is why I'm very bullish, and I talked about it in my live session also, that I'm extremely bullish on the auto ancillary space. And this is also one of the stock that could do well, although not one of the renowned stocks, but is still down about 50-60% from the all-time highs. Results have been strong even in difficult times, so that is a huge positive for the company. Higher institutional holding, higher holding by you can say strong players is also a huge positive. Why did the slowdown take place at the first place for the auto industry? So auto industry altogether was under stress from 2017 because of the economic stress here in India, plus the commercial vehicle segment to which it caters the most was the most hit for the last 3-4 years. In fact, for the last 6-7 years it has been hit badly, but it had a phase of 1 or 2 years between 2014 to 16 where the commercial vehicle space did slightly better. But after that, for the last 3-4 years, things have been really pear-shaped for the CV segment, and now it looks like that the growth is coming back into real estate infrastructure. There's a semblance of the growth coming back, and that's why I believe that the CV segment would come back over the next couple of years, and the stocks catering to this segment would do well. So economic slowdown hurt the infrastructure to the core, and that hurt uh, uh, indirectly these auto ancillary companies which catered to the CV segment, which is directly related to the infrastructure growth. So projection of further stress in the next 2 years meant that were not buying it, but I believe over the next 6 months to 12 months things will be back on track. So this sector went out of favor, but I believe over the next 6 months on major declines, these stocks will be bought into. If you look at the technicals, then major long-term support is around 1600 levels, which is way down. So it's down something like 40% from here. But it has taken out a major, you can say, resistance of 2300. So a strong up move is expected as things getting better. But even if there is a correction towards 2200, it's a good long-term buy with a 1600 stop loss. If you want to trade into the stock, then you can keep a stop loss at 2200 and buy the stock. But I would suggest that have a long term view and buy on slight declines towards 2300 with a stop loss at 1600. It is looking very strong on chart and may consolidate for few weeks here because the surge has already taken place. So my call on the stock is hold if you have it, buy on major declines. If you don't have it, don't get into it at this point of time with the market surging so much. Cycle looks like it's turning around at the moment, so that's what I mentioned. And this is one of the top players in the ancillary segment, especially in the CV segment. So it's a good 3 year play. No immediate reward is there. So buy on declines, keep accumulating over the next 6 months, and put only 5% of your total holding. So this is my video on Sundaram Clayton. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.